Hi, this is Terry. This is the first attempt using Camtasia to do the statement of cash flows. We're just going to give it a try and see what happens here. I'll give you a little background history on statement of cash flows. The old name for the statement of cash flows was the statement of changes in financial position that was done on a working capital basis. The statement itself, which is the fourth statement, you have the income statement, then the statement of retained earnings, and then the balance sheet. This is the fourth financial statement. And it was done, what it does is it explains how cash changed from January 1st to December 31st. So it's a way of looking at your company not from an accrual basis, but from a cash flow basis. And that's an important concept because you can own a yacht, you could own Mercedes, you could own penthouses in New York, etc., and still not have a dime in your pocket. So it's important that a company not only keep track of what it's doing from an accrual perspective, which is what the first three statements do, but also from a cash flow basis. There was a company called W.T. Grant, and W.T. Grant was the exception to all these rules. Everybody thought for sure that the company was great. They were the Walmart of their times. And the statement of changes in financial position wasn't sufficient for investors to realize that the company was going bankrupt. They were just borrowing ungodly amounts of money, and nobody knew it because back in those days we didn't have the computers and the resources. We're talking about the 50s and 60s here. So finally, they turned around and said, what we need to do is revamp this statement, and it became the statement of cash flows. What I'd like to do is use these handouts that are from another text, from another publisher, and we'll use certain of those slides to explain the statement of cash flows. So let's move on, and we'll see how it goes. In all of these statements here, I don't think we need all those little marks if they're showing up here. Let's see if we can get rid of them. If we arrow up and arrow back down, there we go. Now they're gone. Okay. The statement of cash flows here, the beginning slide in all these Transparency Masters, and I'm going to upload quite a few of them for you, tells you what you're supposed to learn out of each one of these chapters. So we should learn what the purpose of the statement of cash is. We should learn what sources and uses, et cetera, et cetera, et cetera. So let's move on. The big issue here is the statement of cash flows, again, tells you what happens from January 1st to December 31st. It's part of the definition of cash is that in the statement of cash flows, it's not only cash, but everything that'll be converted into cash within 90 days. So if you have cash and you're going to go out and put it into a 30-day treasury bills, just so it's earning some interest. As far as the statement of cash flows is concerned, those treasury bills that are going to come due within 30 days fit into the cash category. All right. The way that let's get more into this later. I would skip these next two slides because I don't think that they're much value to you. But on slide that's marked number 6 on our screen here, the statement of cash flows is divided into 3 areas. The 3 areas are operating activities, investing activities, and financing activities. The operating activities is everything to do with the current assets and current liabilities. Remember that current assets and current liabilities are, by definition, going to be current assets are going to be converted into cash within 1 year, 1 operating cycle. Current liabilities will be paid within 1 year, 1 operating cycle. The investing activities then are long-term assets. That's when you go out and you buy a building, you buy land, You make long-term investments. You buy shares of stock. Chicago Tribune would go buy shares of stock in forests to make sure that they have wood pulps to make paper. And then the financing activities are long-term liabilities and owner's equity account. So these are how you go out and get cash. The long-term liabilities would be taking out a mortgage for a building or issuing bonds. Obviously, the investor gives you cash for the bonds. And the owner's equity would be common stock, selling common stock and preferred stock. Also, dividend activities are in that area. So the next little section just gives you those definitions. It tells you the operating activities, investing activities, and financing activities. And again, you can go through these Transparency Masters, these TMs. They're loaded out into WebCT, so you can either listen to this video or just go out and read that on your own. If we move on here, the first section is called Cash from Operations. And this is a tricky one because there's two different methods of doing the cash from operations. The first method is called the direct method, which is preferred. It's preferred by the FASB. They turn around and say, this is the method that is the most accurate. The problem is that if you do the direct method, you must do the indirect method to prove the numbers from the direct. So most companies turn around and say, well, yeah, if we have to do both methods, or we could do the indirect method, or if we have to do the direct, we have to do both. We might as well just do the indirect and be done with it. So that's what most companies do. The next several slides are going to tell you how to make the statement of cash flows, and what I want to do is just arrow down into more of an example instead of the explanation. What we're looking at, what you do here is you look at your balance sheet, because we're going to do the indirect method. You look at your balance sheet, and you're going to look at each of your items on your balance sheet and your income statement, and you're going to show from the previous year to the current year, so year one and year two. And so in year one, we have cash of $6. In year two, our ending balance is $13. Remember that the ending balance of year one is the beginning balance of year two. So what we're trying to prove is, why did cash go from $6 to $13? And what you want to do is then compare these numbers. For this example, then, they're going to give us an income statement. And this particular income statement, we're showing sales minus cost of goods sold is gross margin, minus operating expenses is net income. Then we have other gains and losses, revenue expenses, gives us income before taxes minus taxes. So we're going to have net income of 19. We're going to calculate a statement of retained earnings. The statement of retained earnings had a beginning balance of 54. We're going to add the net income, which came from the income statement, and then we'll subtract dividends to get the ending retained earnings balance. So we're just setting ourselves up with all the data. And what you want to do is you want to look at the change or the movement in all of these different accounts. And what I'd like to do is skip over and go to other slides, because I think it'll be clear if I just jump to those slides. So let's get to that section. All right, and so here's what I want to get to, is this section right here. The first section is operating activities. Right, we'll circle that baby here, see if it'll circle. There we go. Operating activities. And what you have to constantly remember is that you're starting out with net income. Net income for the operating section is the beginning point. And then you're going to follow 5 rules that you're going to convert the net income to the equivalent of cash. Remember that you have revenues minus expenses, is net income. So the rules that we're going to be following are going to reflect that you're already starting with net income. So the first rule is that you add back depreciation. Because you had declared depreciation to be an expense, there's no check written for depreciation. So the way that you can reverse the effect on net income is to add that $8 back in. The next section, which is going to be accounts receivable and inventory here, the idea is you'll work with all your current assets, and they're inversely related. So if there's a decrease in accounts receivable, you add it. If there's an increase in inventory, you subtract it. They're inversely related. And if you look into a T account, then I think that will make sense. That if you looked at something like accounts receivable and it had a beginning balance of 10, an ending balance of 5, and current charges during the period were 100, you're saying that your revenue is going to reflect those current charges of 100. But the cash that you actually took in had to have been 105. You would have recorded a debit to accounts receivable, credit to sales. But then when the cash comes in, you would debit cash and credit accounts receivable. So if that account has gone down, it means that you've collected all the money that you were supposed to collect and more. So if you look at the credit side of that accounts receivable, you'll see that you actually collected $5 more than your sales. And again, since your beginning point is up here with our net income, what you have to do to convert that back to a cash basis is add the difference between the beginning and the ending balance. The same concept goes with inventory. The third rule then deals with accounts payable. So this will be your current liabilities. So increase in accounts payable and decrease in your accrued liabilities. The issue there is that they're directly related. So if you increase accounts payable, you add the change from the beginning to the ending balance. And if you decrease your liabilities, then you would subtract. And this should kind of make common sense, because if you're not paying your bills, you've got more money. You will have recorded the expense and the accounts payable, but if accounts payable is going up, then you've recorded the expense that fits into this net income figure. But if the accounts payable goes up, it means you just aren't paying your bills. And if you aren't paying your bills, you have more cash. The fourth rule is taxes payable, and taxes payable are the same as step number 3. So step number 4 and step number 3 are basically the same. They just separate out taxes. So if your taxes increase, your taxes payable increases, you have more cash because you're not paying your taxes. You'll have recorded the expense, but you will have not used that money for the payable. And gains on sale of equipment, when you calculate your net income, you will have when you calculate your net income, you will have added gains and subtracted losses for tax purposes for the IRS. But there is no gain, there is no cash involved on the gain. There's cash when you sell the equipment. So the cash is cash, but the gain is not cash. And since that gain is not cash and you've added it, what you have to do is reverse that scenario so that you can to take out the effect of the gain. Once you do that, you'll see that what happens is, although you had 19 in net income, you actually had a positive cash flow of 25. And so if you were thinking of this in terms of millions or even billions of dollars, the difference between 19 billion and 25 billion is significant. The next section is your long-term assets. So these are your long-term assets, and those should make common sense. That if you add to your plant and equipment, you buy more building or buy more equipment, you're going to use cash. If you go out and buy more investments, you're going to use cash of 14 here. If you sell equipment, then that's going to be an inflow of cash. That's going to be a source of cash. And the bottom section is your long-term liabilities and owner's equity. And the issue there is if you have sold more bonds, so if your bonds payable is increased, you've got more cash because that's what people give you. If you've sold stock, you've got more. If you've paid out dividends, you have less. So those should make sense. Then if we look at this statement of cash flows, we've got 25 sitting here in from operating activities. We've got 26 in investing activities, and we've got 8, a negative 26, and then we've got 8 sitting here from financing activities. So if you look at this entire thing, you'll see that our beginning balance was 6. We had a net change of 7, and so the ending cash balance is 13. We've just proven, where our cash balances are. All right. The next issue then is to kind of explain, once you know how to mechanically make the statement of cash flows, then the problem is how do you interpret it? And in the absence of any information, you're turning around and saying at this point here that you have $25 in operating activities from running your business. You use 26 by going out and spending. So you spent everything you made. And the only reason that your cash increased from 6 to 13 is that you went out and issued more bonds and stock. Well, the problem with bonds is you got to pay the interest. And problem with stock is you got to pay dividends. Otherwise, your investors will go put their money, they'll sell your stock and put it someplace else. If they sell the stock, then your price is going to go down. So in the absence of any other information, you're saying, well, they're spending everything that they're making. If this is planned, this is great. It's not a problem. But some of the issues that you'd want to look at is there a huge difference in accounts receivable and inventory and accounts payable? Those 3 items tend to be the biggest ones. If your accounts receivable goes way up, let's say that was 10 or 15, the issue is if you're operating at the same level of sales, then the change in accounts receivable from last year to this year should basically be 0. And if all of a sudden it's a huge number, all of a sudden you jump up 10 or 20, then what you're doing is letting more people charge, so you've deteriorated on your collection policy. That's a huge issue. And if all of a sudden you got a whole bunch more inventory, if you haven't introduced more products, then why should your inventory change at all? And ultimately what usually happens is if your accounts receivable is going up and your inventory is going up, then the one way that businesses compensate for it is they're just not paying their bills. And then that becomes an issue that if you're not getting the cash, you can't pay your bills. So if you do any type of evaluation, these 3 items here are the big ones to go take a look at: accounts receivable, inventory, and accounts payable. A couple more issues that you can run into in doing homework, we're not going to do the direct method, is that, let me give myself some white space here, that when you go look at a building, and let's say the building account starts out with 10 and you go out and buy 50. Then you turn around and you have a 40 as a balance. What they won't tell you in the homework problems is that the fact that you've got 10 and 50 is 40, you must have sold 20. So you want to look for that issue of what's implied but not explicitly stated. Another issue is to look at dividends and recognize whether it's revenue or dividends as a reduction of owner's equity. Just make sure which direction it's going. Is it dividends that you're receiving from a company, or is it dividends that you're paying out? If it's dividend revenue, by definition, it's going to show up in the net income, which is going to be an operating issue. If it's dividends you're paying out, it's an owner's equity issue, and it's going to show up in the financing section. Another issue is that anything that bypasses cash. If we would buy a building and give somebody common stock, then you've bypassed cash, and any major issue like that needs to be reported in a separate schedule that supplements the statement of cash flows, so that investors have full disclosure of what's going on with cash. And the last thing that I would give you is that compound entries may affect multiple areas. So if you're going to take off a mortgage payable and you have interest expense and you're going to pay cash, the interest expense will be in the operating section. The mortgage payable is your long-term liability. And so you're going to have this journal entry is actually going to affect two sections of the statement of cash flows. This was down and dirty and just a very quick 20-25 minute attempt to give you the information. If it's helpful, let me know. If it is, then I'll practice and do more of those, and they'll get a little smoother as we go along. All right, wrap up number 1, huh?
That's all, folks.